Welcome to the fifth video in this series, aimed to assist business owners and managers to better understand and manage the finances of their business. This is the first of our complementary sessions, in which we'll be looking at the statutory accounts that your accountants produce after the close of an annual financial year, including what do they contain, what do they mean, who looks at them, and how can you manage them. Statutory accounts are a formal set of accounts for a set period, usually 12 months, which are filed at Companies House for public record. Company directors are responsible for the accurate and correct production of annual accounts and the filing of true and fair accounts at Companies House. Hence, it's vitally important that you understand them. All UK limited companies are required to file accounts within 9 months of the end of the period they cover. For example, accounts for a period of the 1st of January to the 31st of December 2020 should be filed by the 30th of September 2021. There are exceptions which limit the amount of information a company has to provide, particularly for micro and small companies. Micro entities are very small companies. Currently, your company will be a micro entity if it has any two of the following: a turnover of £632,000 or less, £316,000 or less value on its balance sheet, and 10 employees or less. If your company is a micro entity, you can prepare simpler accounts that meet statutory minimum requirements, send only your balance sheet with less information to Companies House, and benefit from the same exemptions available to small companies. Your company will be defined as small if it has any two of the following: a turnover of £10.2 million or less, £5.1 million or less value on its balance sheet, and 50 employees or less. If your company is small, you can use the exemption so your company's accounts do not need to be audited. Also, choose whether or not to send a copy of the director's report and profit and loss accounts to Companies House, and send abridged or simplified accounts to Companies House. You should be aware that these figures for qualifying criteria do change over time, and it's important that you remain up to date with the status of your business to be sure of your responsibilities. Let's explore the broad definitions of elements of the statutory financial accounts now. The profit and loss account is a record of the sales or revenue generated for a set period, usually 12 months, the costs associated with those sales, and the resultant profit or loss. The balance sheet is a statement or snapshot at the end of the last day of the trading period of the assets and liabilities of the business. This effectively calculates the book value of the business. Book value is very often very different to what the business is actually worth. This will be explained in more detail shortly. The main content of the profit and loss account, or P&L, is the sales or revenues for the period, sometimes referred to as turnover. This can also include non-sales income such as property rental, profit on sale of an asset, or government financial assistance, for example COVID packages. The direct costs, also known as variable costs related to those sales, these are the costs that go up or down in proportion to production, i.e. materials or ingredients, or labour specific to the production of the goods sold. The gross profit, this reflects sales or revenue minus the cost of producing said goods. The overheads, also known as indirect costs, paid to keep the business running. These are not directly connected with the production of goods sold and include items such as rent, rates, insurance, bank charges, administration, wages, office cleaning, depreciation of assets, and so on. The pre-tax profit or loss is what's left over after all operating costs have been deducted, but before tax. The net profit or loss is the resultant figure after all costs, including tax. The main elements of the balance sheet are fixed assets. These include property, vehicles, machinery, equipment, etc. And values are shown after depreciation has been charged. Depreciation is generally the estimated reduction in value of the asset, as it's older and has undergone further use. Current assets. These include stock, comprising raw materials or ingredients, finished goods, and work in progress. Debtors, so monies owed to the business, prepayments or advance payment for services, and cash and bank balances. Current liabilities are what the business owes to its creditors, including monies owed to suppliers, VAT, tax, national insurance, and so on. Also accruals, which are goods received but not yet invoiced. Any overdraft, invoice finance outstanding, and the next 12 months of capital repayments due on loans or asset finance. Directors' loans. These are often included here, but can be misleading, as very often there is no intention of repaying these within the next 12 months. More about this later. Long-term liabilities are loans and asset finance amounts due to be repaid in more than 12 months. The capital position. Simply put, this reflects the value of assets less the value of liabilities. This is often referred to as equity, shareholders' value, or net assets. The net book value. This is a theoretical value and not the actual value of the business. The value of a business is the amount somebody is prepared to pay you for it. There are numerous ways of calculating the value for different purposes. For example, to sell, to attract investors, or for inheritance tax purposes, and so on. Let's now consider which entities might want to look at your business accounts and why. Credit reference agencies are constantly gathering data to build up-to-date assessments of your business that they can then charge their clients for. Banks, finance companies, and credit card companies constantly need up-to-date information to assess and review the creditworthiness of your business to aid lending decisions. Suppliers may assess the risk of allowing your business any trade credit and determine the terms of trade available. Customers may want to know your financial strength and reliability and to understand if your business will still be supplying them next month or next year. Potential investors, to better understand the financial structure and any potential areas of financial risks in your business. However, this would be only one of many areas they would look at. Potential purchasers, for the same reasons as potential investors. Competitors, as part of their strategic planning. If they spot a weakness, they may choose to exploit it. Or if deemed very strong, they may well choose not to go head-to-head against you. Public persons and the local community, to assess the potential effects on the local community. From the accounts, financial analysts calculate a series of ratios and percentages which give an indication of the strength of the business's balance sheet. For example, looking at how the business could survive a crisis or a challenging trading period financially, whether or not the business has sufficient working capital to grow, whether or not the business can afford to repay potential loans if agreed. Is the business able to pay its debts as and when they fall due? How long on average a business takes to pay creditors? How long on average a business must wait to be paid? And how long stock is held for, as stock is deemed to be cash tied up. In particular, analysts look at trends. For example, profit performance or balance sheet value over a 3-year period. Generally, they are looking to see consistent or improving profit levels in the P&L and increased net book value in the balance sheets. Looking at one set of accounts in isolation can be very misleading, particularly the balance sheet, as it is literally just a snapshot of how things stand at that moment. It could completely change the very next day. For this reason, it is worth considering whether your annual financial year-end is in fact the best time of the year for your business. Does it show the business in the best light? For example, if your business is seasonal, it might be best having the year-end at the end of the season and not the start of the season, as stock levels, cash levels, and so on might be very different. It's certainly worth discussing this with your accountant. As directors are responsible for the accuracy, content, and filing of statutory accounts, it's important that they understand them, but also have input as to how they appear. This doesn't just mean checking them over before they are submitted to Companies House, but also considering the impact on them of all the transactions undertaken during the year. Don't be tempted to minimise profits to reduce tax bills. Instead, try to demonstrate a steady flow of retained profits in the business year on year. It's a dilemma to minimise profits to pay less tax, whilst trying to show good profitable trading to the outside world, thus enabling the company to gain better trading terms from suppliers or banks. An accrual-based accounting system is the most commonly used in the UK and preferred by HMRC. This way, a business records costs of sales against actual sales. This is different to a cash accounting system, where sales and costs are logged in the system on the dates the cash is actually received or paid away. This system will invariably show a different profit position for the period than an accruals system. Using an accruals accounting system is far better to enable business owners and leaders to assess management information regarding profitability and cash flow. As stated earlier, the directors are responsible for the accuracy, content, and filing of the statutory accounts. Before submitting them to Companies House, consider who's likely to be reviewing them and what can be done to present the business in the most favourable light. In the balance sheet, consider directors' loans. This can be a complex subject, but generally they are a sensible way of accruing money owed to directors for their effort, time, and capital injected into the business at a time when the business needs its cash flow to grow. The monies can be accrued in this way and then paid back, tax-free, at a time when the business can better afford it. However, directors' loans don't look good on a balance sheet and can be perceived negatively. This is because they are classed as current liabilities, which might imply to the external viewer that the business is under some pressure to meet these liabilities. If the directors are agreed that the monies are long-term liabilities, i.e. they don't plan repaying them in the short term, they should be dealt with differently to improve the look of the balance sheet. Two options are: 1. Draw up an agreed repayment schedule for some time in the future, thus classifying them as long-term liabilities. Or 2. Convert the debt to shareholding. This can lose the tax-free protection, but if the business grows in value, the shares will be worth much more in years to come, when they can perhaps be sold. This option improves the look of the balance sheet, potentially improves the credit score, and gives comfort to potential lenders and investors. We regularly recommend this course of action, but only subject to the advice and guidance of your accountant. These actions will both improve the feel of the balance sheet, but the shareholding option more so than the long-term liability option. Fixed assets. As mentioned earlier, fixed assets are generally shown at original value, less depreciation. Your accountant will probably have decided what depreciation policy to take. There are advantages and disadvantages to depreciating assets too aggressively. The amount you depreciate your asset by can be charged as a cost in your P&L, thus reducing profits. However, this has the adverse effect on your balance sheet, as the assets are worth less, hence the net book value will also be less. Ultimately, a sensible and realistic depreciation rate is recommended, which reduces the value of the asset in line with real values. In the food and drink industry, we see many businesses who have depreciated valuable kit over, say, 5 years, yet the asset is still working hard 15 or 20 years later. But the balance sheet understates the value of the asset to the business. Debt versus equity. As a general rule, don't take on levels of debt in excess of the book value of the business. This is a key ratio that lenders look at. It's called the gearing ratio. It's something you can easily calculate yourself by dividing total debt by the book value or equity multiplied by 100. Although it's called a ratio, it's generally expressed as a percentage. If or when debt does exceed book value or equity, it can suggest that the business is under pressure and that much of its profits are going to service the debt reduction. A gearing ratio of higher than 100% is generally deemed risky. If your business clearly needs increased funding to grow it to the next stage and already has significant debt, then consider investment, which does not accrue interest or require capital repayment. Investment into a business also improves the look and value of a balance sheet. Stock. Tight stock management is critical, as clearly stock uses up cash, and without cash, a business cannot operate. Establish an internal method for measuring stock days, which will show how quickly or slowly stock is turned over or used. Set targets for stock days as a KPI. The lower the better, and monitor these regularly. Adopt a disciplined approach to chasing debtors and not allowing late payment within reason. Some would say there are no friends in business. Establish terms of trade clearly, in writing at the outset. Again, measure debtor days and set realistic targets to aim for. The lower the better. The lower the stock and debtor balances held, the better the cash flow in your business. Try not to make a habit of late payment to creditors. Negotiate credit terms, agree them, and stick to them. If you can't pay, communicate with the supplier and request extensions. Don't ignore them, hoping they will go away. Establish an internal management information system to measure creditor days and set a realistic target to aim for. Having a track record of late payment will damage your business credit score, which in turn will limit your credit terms with suppliers. Measurement of these 3 financial terms, stock days, debtor days, and creditor days, should be a standard part of your management information system. We discussed management information systems and management accounts further in video session 3. As stated earlier, it's worth considering whether your annual financial year end is in fact the best time of year for the business. This is particularly important for seasonal businesses. It's relatively straightforward to change year end, and your accountant can advise on this further. Let's now consider the challenges for new businesses. A new company doesn't have a track record of successful trading, and rarely has strength in the balance sheet. Therefore, obtaining trade credit is difficult due to a low credit rating. If you produce management accounts and they show decent performance, then why not share these with suppliers and banks, etc., to gain their confidence? New businesses generally have to gradually build goodwill through paying for supplies on cash terms and slowly gain trust to obtain some credit from suppliers. They also normally rely on owners' funds, often known as bootstrapping, or from the 3 Fs, friends, family, and founder, to get started before sales revenues begin to flow and profit is generated. Owners are often forced to take minimal income from the business in the early years, leaving the cash in the business, classed as directors' loans. Financial planning is critical for new businesses. Many new businesses underestimate their financial needs and run out of cash very quickly, falling into the trap of being profitable on paper, but having no cash to continue trading. Very often, the statutory accounts prepared by your accountants and submitted to Companies House are the primary source of data that credit reference agencies base their credit scoring system on. Therefore, they will have a major impact on credit made available to you by suppliers and financial institutions. Bad news, for example, late submission of annual returns to Companies House, excessive creditors on your balance sheet, or deteriorating trends of profit or value will all reduce your credit score and alert existing and future suppliers and banks, etc., to the concerns. If a director of your business is associated with another business that also files later than it should, this can have a negative impact on the credit score of your business. Ensure that you have meaningful discussions with your accountants before the accounts are finalised for submission to ensure that everything reasonable has been done to present the accounts in the most favourable light possible. Good housekeeping is important. For example, pay creditors on time and don't stretch terms. It's much better to request longer terms than to abuse existing ones. Your credit rating will be very important if you are looking to scale up, as your business will probably require increased trade credit, increased working capital, increased longer-term finance, and so on. In summary, the statutory accounts are the responsibility of the company's directors. They represent the first impression of the strength of the business to potential lenders, investors, suppliers, and credit reference agencies. It's important for directors, with advice and guidance from the accountant, to manage the impression that can be perceived from these documents.